Hi guys, let's do a technical analysis for Ascendas REIT, and this is for September 2022. This is the candlestick patterns for the past 1 year, and this is extracted from Yahoo Finance. So it's always tempting to draw some diagonal trend lines to see some trends, whether it's on uptrend or downtrend or breakouts and stuff. But in general, I find this exercise in this case not very useful. So if you were standing in February or March of 2022 and done the trend lines, this is what you have seen, right? Because you were in March 2022 and the future is not known, right? And you draw the trend lines connecting the tops and the bottoms, and this is what you end up with, right? So you will see a narrowing wedge pattern reflecting the narrowing volatility converging towards a 2.70 point, right? I think this point is quite interesting though. It's one result of the exercise that I find interesting. So let's talk about it subsequently. But in this case, you will think, oh, it's narrowing and it's going to converge over here, right? And then as time passes, the subsequent price action reveals itself, and you have thought that this is a pretty bullish breakout, right? But you can see that the subsequently it turned out to be a false breakout, and things quickly settle back into the channel over here actually. This went on for next 3 months. It was a brief rally signaling a breakout, and then subsequently the whole thing was invalidated, right, with a very big sell-offs, and the whole thing just went back to the range, and indeed it converged on 2.70. And if you were standing here in the second half of 2022, and then you were to draw some trend lines, you again connect the tops, right? And this is probably what you end up with. And the conclusion would be different, right? Instead of a convergence of 2.70, you think, oh, this is kind of a channel with a constant width on a downtrend. But again, there's a breakout pattern emerge again. But again, the whole thing just reverses itself, and now it's kind of threatening to go back into the range again, right? In September 2022. So you can see that the this diagonal trend lines perspective just gave rise to many false breakouts. It's not very easy to trade this way. Just many false breakouts. I think the better perspective though is on a horizontal trend line perspective. So if you look at it, you can draw pretty nice lines. First at the 3.15 area, and then you draw another line over here. Right? See the support top over here and the bottom over here at the 295. And then you can see another very visible line over here, right? The 275 area. So you can see the top, the bottom turn, the support turn resistance, and then the support over here, and also a bit of a support over here. So this is the 315 area. So with a DPU of around 15.8, 15.6 cents, this is roughly a 5% dividend yielder. And the 295 area is a 5.35% yielder. Over here is a 5.7% yielder, right? At 275. It's quite interesting though that the horizontal lines are quite very clearly defined, right? You can see, and it's all in a 20 point range. So 315 to 295, 295 to 275. So it's all 20-point range, right? And this 20-point range just corresponds to a 35 basis points of a dividend yield pickup. So it's kind of a bumping all over the place, right? Bumping from this channel to this channel, attempting to break out, failed, collapse back to this channel, break in again, and then threatening to break out, failed, come back here again. So I think this horizontal trend line perspective is more significant and it's more meaningful, right? Which is just a reflection of the realities of the matter, right? This is a dividend yielder, solid dividend yielder, and just gonna fluctuate according to market expectations of a future rate hike paths. So I think this path is quite interesting. And quite interestingly, this 2.7 area that we talked about just now, when the narrowing wedge patterns seem to converge, in reality, really did come true. So you were in March of 2022, and you look at the narrowing wedge pattern, you think that it's going to converge at 2.7, and it's 2.7 indeed come true. The markets really did settle there, and it's this magical level of 5.7%, right? So I think the combination of these two charts just suggests to you that this area is a very strong support area, where a lot of our market participants are happy to buy this stuff, a dividend yielder, a solid name at the 5.7% yield. If you look at the CMF, the Chaikin money flow, it's even more clear, right? So right from end of 2021, you can see there's a massive sell-off. from the $3 area all the way down over here. And this is just if you look at the CMF actual statistic, it's even more revealing, right? It hit of a low of 0.7, which is very high for such a big cap, large size liquid REIT. So it went on for months, went from November 21 all the way to March 22. So for a good 4 or 5 months, it's just money flowing out every session. Wow, a lot of sessions actually. So you can see it hit the 0.7 and stayed at 0.7 for quite a long while. So indeed, a lot of funds were flowing out over this area. And then subsequently in mid of 2022, the same thing happened again. Big money outflow. So you can see that the CMF gave very, very good information, right? That the price action for this graph was dominated by institutional flows. So large flows were flowing out of this REIT for the greater half of 2022 actually, starting from the late 2021. So if you look at the price action from a 5-year perspective, actually it's also very interesting, right? You can see that actually this stuff has been just very steady, not really a lot of price action. Well, of course you have this area over here which is really a function of COVID, right? So if you look at the price action on 5-year perspective, you think it's very volatile, right? But actually a lot of the volatility is actually because of COVID, right? If you replace this area and you eliminate this area due to COVID impact, you can see that the price action has been quite contained, very steady, not really a whole lot of money speculating and stuff. And I see very nice trading bands, right? Prior to 2020, in 2017 to 2019, this one was pretty much a 2.5 to 275 trading band kind of stock. And this, of course, the disruption from COVID, which we just ignore. And post COVID, and this is the new realities, right? It's now a 275 to 320 REIT. So you can see the resistance over here turning to support, right, at 275. And this again is the level that we talked about just now at the 275 area with the narrowing wedge convergence into. So I think this level is really interesting at 275. Be it on a diagonal perspective, on a horizontal perspective, on a 1-year perspective, on a 5-year perspective, it came in very, very prominently. And therefore this dividend yield of around 5.6, 5.7% seems to be a key area for this blue chip name. So if you look at this bars over here, right? This was due to the placement of the REIT at the 3.026 in a private placement and 296 for the preferential offering. So they raised $1.2 billion to buy acquisitions in Europe, US, and Australia, and therefore this accounted for this big price volatility over here. So you can see that the in the 3 years from 2017 to 2020, this stuff was kind of trading bound in this 2.5 to 275 area, and then the disruptions from COVID. And you can see that there was a nice uptrend before that, right? Where everything was disrupted by COVID, and it was on a nice uptrend. But then once the news broke out of the pending acquisition and the capital raising, market just sold off very fast. And then eventually this was the outcome of the placement. And there's a lot of volumes over here due to the placement. And subsequently things just settled in this new trading band, right, of 275 to 3.2 area. So I think this is the conclusion for this REIT actually. Very well behaved. The old range of 250 to 275 is now replaced by the 275 to 3.2 area. And this 2.75 area is one very key level to watch from all charts so far. Whether or not it breaks, whether or not it supports, it's going to be very key. But I think this makes a lot of sense from a fundamental perspective. For this name, which has been around for what 20 plus years already, giving a yield of around 5 to 5.8%, I think is solid protection versus the 10-year treasury rise. So I think if you get some levels around here where it used to 5.8% or south, I think a lot of people will be very, very happy to just snap a piece of it and just buy for the long term, right? especially when this guy is going to exhibit quite a fair bit of organic and inorganic growth. So I think that's it for this video.